Well, I've been getting a lot of questions lately about interest rates. People call me up, they send letters, they stop me at the annual meeting and ask, Warren, what do you think about these high rates? Are they going to stay high? Should I be worried? And I always tell them the same thing. Interest rates are the most important variable in the financial universe. They're like gravity in the world of investing. When gravity changes, everything else changes with it. Now, let me be clear about something right from the start. I'm not here to predict where rates are going next month or next quarter. Charlie Munger and we never spent much time trying to forecast the economy or interest rates. It's a waste of energy. What we do instead is think about what different environments mean for businesses and what that means for us as investors. And right now, we're living through something pretty significant. For more than a decade, from around the financial crisis all the way through the pandemic, we had interest rates near zero. The Federal Reserve kept them there. Money was essentially free. You could borrow at 2%, 3%, sometimes less. Companies got used to it. Investors got used to it. Everybody got comfortable in that world. But starting a couple years back, everything changed. The Fed started raising rates, and they raised them fast. We went from near zero to 5% and change in what felt like the blink of an eye. And here's the thing, those rates have stayed high. This isn't a temporary blip. This is a sustained high rate environment, and it's changing everything about how businesses operate and how they should be valued. That's what I want to talk with you about today. Not to scare you, not to tell you the sky is falling, but to help you understand what's happening, and more importantly, why this creates some of the best opportunities we've seen in years for disciplined investors who know what to look for. Let me start with something basic. What do interest rates actually do? Well, interest rates are the price of money. When rates are low, money is cheap. When rates are high, money is expensive. And just like anything else in economics, when the price of something goes up, people use less of it, and they use it more carefully. Think about it this way. Imagine you're running a business and you need to build a new factory. Back when rates were 2%, you could borrow $10 million and your annual interest cost would be $200,000. That's manageable. But now, with rates at 5%, that same 10 million costs you 500,000 a year in interest. That's a big difference. Suddenly, you have to ask yourself, is this factory really worth it? Will it generate enough profit to justify that higher cost of capital? That's the first big change we're seeing. Companies are being much more careful about how they deploy capital. They're not just borrowing and spending because money is available. They're thinking harder about returns. They're being more disciplined. And you know what? That's healthy. For years, we saw companies taking on debt to do all sorts of things: stock buybacks, acquisitions, expansion projects that barely made economic sense. When money is free, people do dumb things with it. But when money costs 5%, you better believe you're going to think twice before you spend it. Now, here's where it gets interesting for us as investors. When interest rates go up, the value of future cash flows goes down. Let me explain what I mean by that. Every business is worth the sum of all the cash it's going to generate in the future, discounted back to today. That discount rate is essentially the interest rate. When rates were near zero, a dollar of profit 10 years from now was worth almost as much as a dollar today. But when rates are at 5%, that future dollar is worth a lot less in today's terms. You have to discount it more heavily. This is particularly important for growth companies, the kind of businesses that don't make much money today, but promise big profits way out in the future. When rates were low, investors were willing to pay enormous premiums for those future profits. They'd value a company at 50 times sales, or 100 times earnings, or even infinite multiples because the company had no earnings at all. The thinking was, sure, they're losing money now, but in 10 years, they'll be printing cash. And with rates near zero, those future cash flows are very valuable today. But when rates go up, that math changes completely. Those distant future profits get discounted more heavily. Suddenly, a company that's losing money today and might make money in 5 or 10 years doesn't look so attractive. The present value of those future cash flows just isn't that high anymore. This is why we saw such a dramatic sell-off in high-growth, unprofitable tech companies when rates started rising. It wasn't that those businesses fundamentally changed. It was that the cost of capital changed, and that changed everything about how they should be valued. Now, I want to talk about debt for a minute, because this is crucial. When rates were low, companies borrowed like crazy. And why wouldn't they? You could issue bonds at 3% and use that money to buy back stock or make acquisitions or fund expansion. Even if those investments only generated 5 or 6% returns, you were still making money on the spread. It was a no-brainer. But here's the problem. All that debt eventually has to be refinanced. Bonds mature. Credit lines come due. And when companies that borrowed at 2 or 3% have to refinance at 5 or 6%, their interest expense doubles or triples. That comes straight out of profits. Let me give you a real example. Imagine a company that borrowed $1 billion at 3% a few years ago. They were paying $30 million a year in interest. Not bad. But now that debt is maturing and they need to refinance. At 6%, they're suddenly paying $60 million a year. That's an extra $30 million coming out of their cash flow every single year. If that company was earning $100 million in profit before, they're now down to $70 million after interest. That's a 30% haircut to earnings just from higher interest costs. And remember, nothing else changed about the business. They're selling the same products. They have the same customers, the same market share. The only difference is that money got more expensive. This is hitting a lot of companies right now. We're seeing it in earnings reports. We're seeing it in their guidance. Companies that looked healthy a few years ago are suddenly struggling because their debt service has become so burdensome. And the ones with the most debt, especially floating rate debt that reprices quickly, they're in real trouble. Some of them won't make it. They'll default, or they'll be forced to sell assets or dilute shareholders by issuing new stock at depressed prices. But here's what I want you to understand. This environment, as challenging as it is for many companies, creates incredible opportunities for the right kind of businesses and for disciplined investors who know how to take advantage of it. See, when money was free, everybody could compete. Weak companies could borrow their way through problems. Bad management could paper over mistakes with cheap capital. But when rates are high, the strong separate from the weak. The companies with real competitive advantages, with strong balance sheets, with high returns on capital, those businesses shine. They don't need to borrow much. They generate plenty of cash from operations. And in many cases, they're actually benefiting from higher rates because they have cash to invest. Think about Berkshire Hathaway. We're sitting on a mountain of cash, well over $100 billion. When rates were near zero, that cash was earning almost nothing, maybe 0.5% in treasury bills. It was frustrating. We were being penalized for being prudent and liquid. But now, with short-term rates at 5%, we're earning over $5 billion a year in interest income. just from sitting on that cash. $5 billion a year without taking any risk, without doing anything except holding treasury bills. That's real money, and it gives us dry powder. When opportunities arise, and they will arise, we'll have the capital to act. We don't need to borrow. We don't need to sell assets. We can just write a check. That's the position you want to be in as an investor. You want to own businesses that have fortress balance sheets, that generate cash, that don't need the capital markets to survive. Because in a high-rate environment, those are the businesses that not only survive, but thrive. They can take market share from weaker competitors who are struggling under debt loads. They can make acquisitions at reasonable prices because sellers are desperate. They can invest in their own businesses because they have the cash flow to fund growth internally. Now, let me talk about what this means for valuations, because this is where a lot of people get confused. In a low-rate world, investors were willing to pay almost anything for growth. Price-to-earnings ratios of 30, 40, 50 times earnings were common. People justified it by saying, well, rates are low, so we should pay more for future growth. And there was some logic to that, but it went way too far. People forgot that businesses still have to generate actual cash. They still have to earn a return on the capital invested in them. When you pay 50 times earnings for a company, you're betting that earnings are going to grow substantially for many years to come. And sometimes that happens, but often it doesn't. What we're seeing now is a return to more rational valuations. Companies are being valued based on the cash they generate today, not on dreams of what they might generate 10 years from now. And that's healthy. It's bringing discipline back to the market. Now, does that mean all growth stocks are bad investments? Of course not. There are wonderful growth businesses out there. But you have to be more careful about what you pay. You can't just assume that growth will continue forever, or that profitability will magically appear someday. I look for businesses that are growing but that are also profitable today. Companies that generate free cash flow, that have pricing power, that can raise prices to offset inflation and higher costs. Those are the businesses that can handle a high-rate environment. Let me give you an example of what I mean. Look at our investment in Apple. Now, people were shocked when we started buying Apple. They said, Warren doesn't understand technology. And maybe they're right about that. But I understood the business. Apple generates enormous amounts of cash. They have over 1 billion customers who are incredibly loyal. They have pricing power. When they raise prices, people pay it because the ecosystem is so valuable. And here's the key thing. Apple doesn't need much debt. They generate so much cash from operations that they can fund all their research and development, all their capital expenditures, pay a dividend, buy back stock, and still have cash left over. In a high-rate environment, that's gold. They're not vulnerable to refinancing risk. They're not going to get squeezed by higher interest costs. In fact, they benefit because they can earn more on their cash balances. That's the kind of business I want to own when rates are high. Compare that to a company that's burning cash, that's relying on the capital markets to fund operations, that's got a pile of debt coming due. Those companies are in a very different position. They're vulnerable. And as an investor, you want to avoid vulnerability. You want businesses that can handle whatever the economy throws at them. Now, let me address something I know people wonder about. Why haven't we been buying more aggressively? We've got all this cash sitting around. Why aren't we deploying it? Well, the answer is simple. We're being patient. We're waiting for the fat pitch. Just because rates are high doesn't mean everything is suddenly a bargain. In fact, a lot of companies are still overvalued relative to the cash they generate and the risks they face. What I'm looking for are businesses that have been unfairly punished, companies where the market has overreacted to temporary problems or where the long-term value is much higher than the current price reflects. Those opportunities will come. They always do. When you've got cash and patience, time is on your side. We can wait. We don't have to do anything. That's one of the great advantages of our structure at Berkshire. We don't have redemptions. We don't have quarterly performance pressures. We can sit on cash for years if necessary, waiting for the right opportunity. And here's what I want you to understand. In a high-rate environment, patience becomes even more valuable because when problems develop, they develop faster. Companies that are over-leveraged, they can't just muddle through for years like they could when rates were low. The higher interest costs force issues to a head more quickly. And when those issues surface, when companies get into trouble, that's when opportunities appear for people who have cash and courage. I've seen this movie before. Back in the financial crisis, when credit markets froze up, we were able to make some of our best investments. We bought preferred stock in Goldman Sachs and General Electric at very attractive terms because they needed capital and we had it. Those investments worked out extremely well, not because we're geniuses, but because we had cash when others didn't, and we were willing to act when others were paralyzed by fear. So when I look at this high-rate environment, I don't see it as something to fear. I see it as something that's going to create opportunities. Not today, maybe not tomorrow, but eventually. The wheat is being separated from the chaff. The strong businesses are pulling away from the weak ones. And for disciplined investors who understand what to look for, who have the patience to wait and the courage to act when the time is right, this is going to be a very good period. Let me close with this. Interest rates are the gravitational pull of the financial universe. When they change, everything else adjusts. We've lived through a decade of near zero rates, and that created distortions, unrealistic valuations, excessive leverage, poor capital allocation. Now we're in a world where money has a cost again, where capital is scarce, where discipline matters. This is actually a more normal environment. It's healthier. And for investors who focus on businesses with strong fundamentals, low debt, high returns on capital, this environment is full of opportunity. You just have to be patient and disciplined. That's what I've always done, and that's what I'm doing now.